quick qualification. How do I just run some quick, simple numbers without having to pull someone's credit, without having to get too detailed, and sometimes get a point across? And I run into this a lot in my career with people who maybe don't qualify. They're frustrated that they don't qualify. They want to take it out on me. And they think that because they have 800 credit scores, they're like, well, I should get a loan. I'm like, yeah, but it's more than that. So I like to talk to a consumer, and I tell them pretty straight up. I said, look, there's the rules, and then there's what we do in the mortgage industry, right? So if I looked up the rules may say that you have a debt-to-income ratio, a front end of 28 and a back end of 43, that's the max. And people don't know what that means. I said, you probably don't even know what that means, and I'll explain to you. I go, but then there's how the real world operates, which actually means I can utilize computer programs and algorithms that will override what the rules say, and they'll give an expanded approval. By the way, that's how I explain DU and LPA. They give expanded approvals, or they give exceptions to what the written rule was. Because that written rule is back from 40 years ago, maybe even longer. But a quick rule of thumb, if you were to talk to any financial guru, right, whether it's the people on the Loan Officer podcast, Dave Ramsey, Susie Orman, Clark Howard, right, those types of folks, they would tell you that your housing payment should never exceed 25% of your gross monthly income. So that's just normal advice. If I was giving it to my 18-year-old kid, my 26-year-old niece, or my 47-year-old sister, I'd be like, hey, rule of thumb, 25% of your gross monthly income. Now I have to then remind people what is gross versus net. Net is the number you see in direct deposit. Gross is the number you see on your W-2. So I asked my sister, I said, well, what did you make last year? She said, I made $84,000. I said, awesome. Rule of thumb is that your housing payment shouldn't exceed more than 25% of $7,000. So math majors, what's that number? I'm going to guess $17,050, or $1,750. But who has a calculator? 25% of 7,000. Is it 1750? Okay. So real easy to how that was done like that is I knew that 10% of 7,000 is 700, so I did 700 plus 700 is 1,400. And then I just needed half of 700, which is 350. So I added 350 to 1,400, I came up with 1,750. Took you longer to pull your calculator out of your sleeve. And I use that not to brag, but to encourage, like, work with your brain and figure out how you can exercise your brain to where your brain starts doing that. My brain's been exercised at doing this for 20 years because whether I'm crunching numbers here in the mortgage industry, before that I was crunching numbers in TV advertising, where I had to tell our advertising clients how a show performed last night. And I had to skew numbers. So that's 20 years of practice. But back on my sister, I'd say 1,750. Rule of thumb. Look, if you're in California and New York, you may have to go to 2,000. Right? But if you're in, Ohio's no longer a state, so I was going to say Columbus, Ohio. Let's say Paducah, Kentucky. If you're in Paducah, Kentucky, which I heard is beautiful land, 1,750, you're like, nah, 1,350. Right? It's a lower cost of living or it's a higher cost of living. But that's just a good rule of thumb. But I then tell my sister, but in the mortgage industry, we can actually qualify you, depending on the loan product, sometimes up to a 45% front end ratio. You have two ratios, two debt to income ratios, front end and back end. Front end is real easy. Take the monthly payment, divide it by the household income, or the gross monthly income, the qualifying income. Not household, you would use the gross monthly. Whatever that number is, so $1,750 divided by 7,000 would say that my sister's front end ratio was 25%. But we can take people as high with AUS approval as a 45%. So when I'm talking to a client and I'm using a quick qualification, I can just say, with my calculator, is how I do it with my headset on. Sometimes I walk around, sometimes I'm sitting down with my feet up on my desk. And I say, hey, Ricardo, awesome. So you work at your job and your job pays you $18.50 an hour. So at $18.50 an hour at 40 hours a week times 52 weeks a year, I would guess that you're making about $38,400. And you were like, yeah. I'm like, all right, cool. Let's just $38,000 to be safe. And you said that your spouse makes 20 bucks an hour. She's a teacher, and actually that'd be a salaried. She's salaried at $42,000 a year as a teacher. All right, cool. So this is me talking to Ricardo. So Ricardo, here's how I'm going to figure out the maximum you'd qualify for. Right? I know that the rules state that I can qualify you for like a 28% front end ratio. The rule of thumb with all the financial experts is 25%. And what that means is 25 to 28% of your gross monthly income is what your housing expense should be. But there's also a back end ratio we're going to have to talk about. I first want to start with the front end ratio. So if you're making 38 and your spouse is making 42, that means each year you guys are making about 80 grand a year. I'm going to divide that number by 12, and I know that your gross monthly income is $6,666 a month. Now I know that's not what you guys see, right? Because I'm sure you have money going to a 401k and money going to health benefits, and the IRS is taking their share, but we qualify everything off of your gross monthly income. So a rule of thumb, Ricardo, is that your total housing payment shouldn't be more than $1,600 to $1,700 a month. That's just a rule of thumb according to those talking heads on TV. Now, I know this. Based on your credit score and based on your loan product, I'll be able to qualify you for a maximum debt-to-income ratio of 50%. So what that means is that I'm going to take that same number, 6666, that's your gross monthly income, and I'm going to times it by 50%, 0.5%. So I'm going to take 50% of that number, and that's going to tell me that your total debts cannot exceed $3,333 a month. Now that's your total debts. So that's the mortgage payment plus student loans plus credit cards, alimony and child support, car payments, etc. So a quick qualification for me, Ricardo, and I think it's what you're asking for, and I kind of went down the wrong rabbit hole or off on a tangent, and I'll circle back the right way, is if I was talking to a customer, I probably wouldn't start with front end ratio. I'd probably start with back end ratio, because back end ratio matters a lot more than front end ratio. And I would have this exercise where I'd figure out that your gross monthly income is $6,666 a month. I figured that out because you make $38,000 a year, your spouse makes $42,000 a year, combined that's 80 grand, and you all are qualifying together. I'm then going to ask you, I said, hey, look, $3,333, that's your total allowable expenses if everything goes right. What's your car payment? Well, I have a car payment and she has a car payment. Cool. What's your car payment? Well, mine's $400, so I'm going to subtract $400 from that number. I'm subtracting $400 from 3333. What's hers? $275. I'm going to subtract $275 from that number. Now I'm down to $2,658. What about student loans? I don't have any student loans, but hers, $700 a month. All right, so I'm going to subtract $700 a month. How about credit cards? Well, I have some credit card debt. I owe $10,000. Well, the good news is I don't need to know how much you owe right now. How much is your minimum payment? One's not bad. One's only $125 a month. But I pay more when I can. It's okay that you pay more that you can. High five that you do. I just need the minimum. Okay, the minimum is $125 a month. Subtract it. Now the other one's a crusher. That's the American Express, and they want $600 a month. So I subtract $600 a month. All of a sudden, without pulling someone's credit, I've now realized that if their credit score is high enough, and if I can get AUS to accept their scenario at a 50% debt-to-income ratio, which I know is high. Hey, Ricardo, if things go our way, we're looking at a $1,233 a month monthly payment. And you're like, okay, what does that mean? Well, depending on how much money you had to put down, you're probably looking at a sales price of somewhere around $165,000 to $175,000. Well, good luck finding that in this market. I know. That's what sucks about trying to buy in this market. Now you may want to look at, heading down into Polk County, maybe heading up into Lake County, and you may have better luck finding those homes. Or if you'd like to go one step further, we can go ahead and pull your credit. I can look at, do you have anything that you could maybe pay off that could help you qualify? Do you have a family member that would co-sign for you? At which point we can add their income to your income, their debts to your debts, and we could qualify all three of you together to see if maybe that would help your situation. So I think what you're trying to ask me, and I took a very long roundabout way to get there, are there some quick ways to do our job to give people the answers they need without spending too much time? And me as a seasoned loan originator, I understand my back end ratios pretty well. I know that if something goes well, I can get them through FHA at a 55%. If something goes well, I can get them through a conventional loan at 50%. And without having to pull credit, that's what I would do. I'd first ask them about their income, and I'm writing notes down, like I equals. And then once I come up with what I think is gonna be their income best case scenario, I then automatically take 45, 50, or 50% of that number. I then start asking them about their monthly payments. Hey, do you have a car loan? Do you have a student loan? Do you have credit cards? What's your minimum payment on those credit cards? Are you obligated to pay alimony, child support, or separate maintenance? And all I'm doing is minus, 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 until I get to a number. That number is going to let me know if I now have a realistic monthly payment with a sales price. Can I marry the two? And if I can't, then we're stuck like Chuck and we have to have another conversation. If I can, it's full steam ahead and let's work on getting you pre-approved. The only caveat, and I started with front-end ratios, so I'll end with front-end ratios. The only caveat is keep in mind there are two separate debt-income ratios. There's a front end and a back end. And the reason why I want to make a note of that, or want you all to make a note of that, is there will be times in your career where someone has no debt. They have no debt at all. I've seen it. Dave Ramsey-ites, people who make good but modest income, and they have no debt. These are people who are fiscally responsible. And I mean, so fiscally responsible, true story, husband and wife shared one car, both worked. She dropped him off at work every day. Like that fiscally responsible. But it was, I think she made like $22,000. She was a preschool teacher. I think he made about $36,000. So their household income, their income was $58,000 a year. And if I just tried to say, oh, wait a minute, $58,000, divide that by 12 is 4833. Oh, I can do a 50% debt to income ratio. That means you qualify for a $2,400 a month payment. I'd get burned. The problem is there's going to be a maximum front end DTI. And that could be 41, 43, or it could be as high as 45%. But that would impact someone who maybe, the difference between 50 DTI and a 45 DTI for this couple who makes $58,000 a year, which is the median household income for Central Florida. The difference, it's about $300 a month in payment. So that's a far way to be off. And when you have someone with no debt, like when you're trying to do a loan for someone with debt and they don't qualify, you look to pay off debt as a solution. Even if it's mom and dad gifting them the money to pay it off. Or even if it's true story, refinancing a car out of their name and into the other person's name. Right? Trying to do a loan for Mr. and Mrs. Smith, but Mrs. Smith has terrible credit. Therefore, we're going to remove her from the loan application, but the car loan is in Mr. and Mrs. Smith's name. Could I refinance the car out of Mr. Smith's name into just as Mrs. Smith? Now he's not carrying that debt. Now they qualify. Right? So when someone's coming to me with a debt load, I could potentially wiggle myself out of a sticky situation by having them reduce their debt load. When you're coming to me with no debt load and I screwed up your DTI because I was just guessing that everything would work off of the back end and I forgot about there's also front end DTIs I have to worry about, I don't really wiggle myself out of that. There's nothing else to pay off.